Let's take a closer look at the underwriting process. Simply put, underwriting is a risk selection and classification process. The insurer's underwriters have two big questions to answer. Is a person insurable? And if yes, what is the appropriate premium to charge them? The primary underwriting criteria for life insurance are the applicant's age and gender, health status, occupation, hazardous or not, lifestyle, for example, are they a smoker, and hobbies. Do they have any dangerous, high risk hobbies? Based on all of the information, the underwriters will classify the applicants to determine the premium rate appropriate for their level of risk. It's important to note that underwriters and insurers cannot unfairly discriminate between individuals of the same class and life expectancy. More specifically, the following will constitute unfair discrimination between individuals of the same class if the insurers discriminate in policy rates and benefits based solely on age or gender, physical or mental impairment, blindness or partial blindness, or genetic characteristics. In addition, investigating a proposed insured's sexual orientation as part of the underwriting process is also considered unfair discrimination. That is underwriting. It's a risk selection and classification process that helps insurers avoid adverse selection. Underwriting must be fair.
When we are talking about insurance underwriting, we often use the term adverse selection. What does it mean? If something is adverse, it means it's harmful or unfavorable. Adverse selection in insurance means insuring risks that are more prone to losses than standard risks. Adverse selection exposes insurance companies to higher levels of risk, for which they are not receiving the appropriate amount of premiums. For that reason, they want to protect themselves from adverse risk selection. How can they do this? If the insurer's underwriters determine that an applicant presents a very high risk for loss because of their high-risk lifestyle or dangerous hobbies, there are a couple of things they can do to minimize the effect of that risk on their ability to pay claims. First, they can simply refuse coverage to this applicant. They can also limit the coverage and say, "We will cover you for everything except for losses from this one dangerous hobby that you have." Or they could charge a higher premium because of the higher level of risk. The role of insurance underwriters is to properly select and classify risks, so they will evaluate all known factors about an applicant to determine their risk level and to minimize the adverse selection.
Remember, producers or agents perform the duties of field underwriters. They are out in the field, so to speak, soliciting insurance policies, meeting in person with potential insureds, completing applications, and collecting premiums for the insurer. Now, think of the insurer as the home base. Once an agent has accumulated all of the pertinent information and premiums, they bring them to the home office underwriters, who then use that information to determine an applicant's insurability. While the policy application is the main source of the information about the applicant on a lot of life policies, especially those with relatively small face amounts, there are those other sources available to underwriters to help determine the level of risk of each applicant. First, there are a few medical reports that underwriters can obtain to dig deeper into an applicant's medical history. One of those is called the Attending Physician Statement, or the APS, when the information is requested from the applicant's physician. The APS helps confirm the information on the application and may provide additional details about the applicant's medical history. Next is a paramedical exam conducted by a registered nurse or a paramedic which may include just blood work, for example, instead of a full medical exam. However, the insurer may also request a full medical exam, especially if the applicant is requesting large amounts of coverage or if the application raises questions about the applicant's health. Know that the insurer pays for the costs of all of these examinations. When requesting a medical exam for life insurance underwriting purposes, especially for large amounts of coverage, it's common for insurers to require an HIV test. There are strict laws in place to ensure proper obtaining and handling of results and to protect the insured's privacy. Prior to testing, the insurer must disclose the use of testing to the applicant and obtain their written consent. Then, the test results may only be disclosed as authorized by the applicant in writing. Another important note, insurers cannot deny coverage based on the HIV test results alone. Another source for underwriting information for insurers is the MIB report. What used to be called the Medical Information Bureau, and now MIB Group, is a nonprofit trade organization, basically a consumer reporting agency that collects, maintains, and shares important underwriting information on applicants for life and health insurance with insurance companies. An MIB report includes information about an applicant's past life insurance applications, as well as dates of diagnosis or treatments for illnesses and various medical conditions, and any hazardous hobbies or habits the applicant has, such as smoking or skydiving, for example. The MIB report only has access to information provided by member insurers on those applicants who have applied for individual insurance in the past 7 years. MIB does not have access to medical files from healthcare providers. There are also a couple of reports an insurer may obtain to determine how much of a risk an applicant presents based on their financial situation, character, hobbies, and habits. Those are called investigative or inspection consumer reports. There are two types of these reports: consumer reports and investigative consumer reports. Both may include information about a person's credit, character, reputation, or habits collected by a reporting agency from employment records, credit reports, and other public sources. What makes an investigative consumer report different is that the information is obtained through an investigation and interviews with an applicant's associates or friends and neighbors. If that report is requested, the insurer must disclose that information to the consumer and advise them that they have a right to request information about the report and the reporting agency. The consumer has the right to know what was in the report and the identity of anyone who has received a copy of the report during the past year. The Fair Credit Reporting Act establishes procedures that consumer reporting agencies must follow to ensure that consumer records are confidential, accurate, and used only for legitimate business purposes, such as the underwriting process for the insurers. Anybody who knowingly and willingly obtains information on a consumer from a consumer reporting agency under false pretenses may be subject to fines and imprisonment. Do you recall the basic definition of a risk? Risk is the chance of loss occurring. In life insurance, risk is the likelihood of an insured dying. To properly classify risks, the insurer's underwriters will look at the applicant's past medical history, present physical condition, occupation, habits, and morals. If the applicant is acceptable, the underwriters will determine the person's rating classification that will be used in deciding whether the applicant should pay a higher or lower premium. An applicant can be rated as one of three classifications: preferred risk, standard risk, or substandard risk. Preferred risks are individuals who meet specific criteria and are eligible for insurance coverage at lower premiums compared to standard risks. These applicants have excellent physical health, lifestyle choices, and habits. Standard risks, on the other hand, are individuals who meet an insurer's underwriting standards and can receive insurance protection without any additional charges or restrictions. They represent the average risk among people of their age and similar lifestyles. Substandard risk applicants, however, do not meet the criteria for standard rates due to factors such as poor physical health, personal or family history of diseases, occupation, or risky hobbies. The policies issued to substandard risks are sometimes referred to as rated because they may be issued with a higher rated up premium. In life insurance, the higher the risk, the higher the premium. So, those are the three basic risk classifications: preferred, standard, and substandard. Insurers do have an option to reject an applicant and decline coverage. A risk may be declined if there is no insurable interest, or the applicant is uninsurable for medical reasons, or if the potential for loss is too great to meet the definition of insurance. Once the underwriting process is completed and the policy is issued, it needs to be delivered to the insured as soon as possible. Let's see what that looks like. If an agent was involved in the insurance transaction, the agent must deliver the policy to the insured, and the best way to do that is in person. When delivering a policy in person, an agent has an opportunity to go over the policy coverages, special provisions, and exclusions, and answer any questions the insured may have. In addition, the agent should explain the rating procedure, especially if the policy is rated differently than applied for, or if it has been modified or amended in any other way. The agent should also obtain a signed delivery receipt, which will serve as proof that the insured now has the policy. A policy can also be mailed to the insured, and a certificate of mailing serves as a proof of delivery. Now, there are situations when the initial policy premium has not been paid at the time of the policy application. In those cases, the agent is required to collect the premium at the time of the policy delivery. Even if the policy has been issued, coverage cannot begin until the first premium is paid. If the premium is paid at the time of the policy delivery, the insured must submit a signed statement of continued good health, confirming that their health has not changed and there haven't been any injuries or illness since the application date. The effective date of policy coverage depends on when the premium is paid. If the premium is submitted with the policy application and the policy is issued as requested, the coverage starts on the date of the application. If the premium is paid at the time of policy delivery and the insured submits a statement of good health, the coverage starts on the date of policy delivery. Sometimes the premium rate may be reduced by backdating the insurance application. But why would someone want to backdate a policy? Backdating allows an insured to lower the premium based on age. For example, an insured just turned 50 years old, which has put them in a new age bracket with a higher premium for life insurance. The insured may want to backdate the policy to 6 months ago when they were 49 years old and would have qualified for a lower premium as someone in their 40s. So backdating is allowed, usually for no more than 6 months, but only for the purpose of lowering the premium. Note that the premium will need to be paid from the effective date of coverage.